have. Okay, let's go live. Yeah, I'll just hide my video. Alrighty, it looks like we're live. I think we're live. Hello there, and thank you for being a bit patient this morning. It's my pleasure to have you on the live chat this week. As always, my name's Owen Rask, and welcome to SelfWealth Live. Every week we go live and we talk about investing, we talk about different topics. Today we're talking about investing for kids, and I can see that Hartley's already said hello. So we said, hey, g'day, Hartley. So the way to say g'day to me on the live stream is just to drop your comment into the YouTube live chat box there. I love questions. I want to hear your ideas. That's it. Rob's already said g'day. Rob's joining me today as always. We're talking about investing, and we're talking about investing for kids specifically today. If you have any questions on this, drop them in there. And as always, my disclaimer is anything that I do answer in this video is limited to general financial advice only. Because I don't know your financial situation, anything that we talk about, any of the companies that we talk about investing in, any of the ETFs, the reality is I don't know what your goals or your objectives are, so you should always speak to a licensed and trusted financial advisor before you act. Another thing to note today, which is really important, because what we're talking about today is, in some parts, it's related to tax. And so tax can be a funny thing in Australia. You have this situation where you can get financial advice from a financial planner, you can get investing advice and investing information from people like me, but you can't get tax advice from either of us. You have to see a tax agent. So it's kind of this weird thing where you have multiple people doing multiple things. And we're going to talk about how tax interfaces with investing for children today. And so if you need to get advice on the tax element of this, go and see a licensed tax agent who can say, this is right for your situation and this is the tax implication. And I think this is more important than ever if you are setting up your child's investing account for the long term. It's good to see everyone said g'day. I'm glad to know you're all still with me from last week. We've got some regulars on the show. Zoe, Amit, Jenny, Jonesy. Always so great to have people watching and to see you guys here. So if you have any questions for me, or you have any of your own perspectives to share throughout the session, be sure to do so. Just drop it in the chat there, and we can go from there. So as always, what I'm going to do is I'm going to talk to you a little bit about investing for kids, or investing generally, and then we're going to dive into SelfWealth. We're going to look at some companies. We're also just going to quickly rehash the passive income video that we did a few weeks ago, and I'll provide the link in the live chat there. So if you're watching this on replay, just jump straight into the live chat little widget there. You might see a little link to it on the side of the player, and then what you can do is you can just scroll down through there and you can see the spreadsheet that we've put together. So that's about it. We've got something really interesting. As many of you will know, if you're interested in investing in ETFs, there's a promotion going at the moment. So be sure to jump into the platform, go back to last week's video where we talked about ETF investing and about ESG in general. And you can learn about different types of ETFs that are available in the market and how you can do that in a super low cost way. So today we're talking about investing for kids, and this is a very pointed episode for many of you, I'm sure, because you're at that stage of your life where you want to invest for someone. And so how do you do that? How do you, kind of just make the decision of which way to invest, what's tax effective, what's not, what should I invest in, what shouldn't I invest in? Last week I started the program with a question for you guys, which was, are bank shares ethical? You might remember that was a bit of a dicey question and we got some interesting responses. Today I want to ask you a question. The question is, how are you investing for the next generation? And so that could be your kids, it could be family, friends, it could be, you might be investing for a cause. How do you do that? I want to know your answers because it will give me great ammunition for the rest of this session. I'll give you an example. One of someone that I know personally who ran a small business and then ultimately sold that business and did quite well from selling that. He actually set up a charitable trust so that once you get to a certain amount of money, you can put the money in, and as long as it has a charitable focus, then that money can be invested and then distributed to charities. And it's highly tax effective, obviously, because it's a charity, and it's a great way to give back on a continual basis. Plant One says, on the road. Plant One, you've been here, I think, every week since we started SelfWealth Live. And if you are on the road today, or if you're saying that I'm on the road, I am on the road, but if you're on the road, drive safe. Yeah, that's right. I'm here in Sydney today, so I'm recording remotely. So we're recording here on the MacBook rather than the iMac for a change, and we had some technical difficulties getting it off the ground, but here we are. So I'm just going to switch over to some of the screen sharing that I'm going to do. And Amit has already said that 10invest is at 10invest by Australian Unity. Hartley says Tesla mainly because I believe in their mission to accelerate sustainable energy. That's fantastic. So we've got two totally different answers there. Amit, can you just tell me with the 10invest? Can you just clarify what you mean by that? Are you talking about the insurance bonds? Is that what you're talking about? The Australian Unity insurance bonds? I'd be really interested in that. Anyway, let's jump across to screen share. I hope you can still see what I'm looking at here. DH says, welcome to Sydney. Thanks, mate. It's great to be here. So we're going to talk about all of the different things that go into making a decision for investing for a child. But you might remember, just as a bit of a refresher, a few weeks ago, we talked about how you can create kind of a fully franked dividend income portfolio, or even just a regular dividend income portfolio from the stock market. And we talked about a bunch of different ideas around how to pick investments that would suit that type of strategy. And then we talked about how you could invest in things outside of the stock market. So all of this stuff here, you could just jump into your SelfWealth account and you could find, say, Argo, which we talked about. You could just jump in here. Where are we? Argo there. Oh, this is the global one. I think it's just ARG, Owen, which I'll get up in just a moment. We could go like this, Argo Investments. So we talked about Argo here being a listed investment company and why that makes a really interesting proposition for long-term investors who are looking at getting dividend income, because Argo's done that sustainably for quite a long while. But one of the things to keep in mind is basically, if we're going to be investing on behalf of a child, what we want to do is we want to maximize the long-term growth of the investment that we make for them. And so, for example, there are some tax consequences that happen. This is the ASIC website, but there's also the ATO website. And I'll put this in the SelfWealth live chat now. So we've got ATO tax on children's investments. And this might help John, who just asked a question. There we go. So tax on children's investments. So there we go. And John asks, is it easy to transfer my son's profile to SelfWealth from another broker? In general, will the transfer trigger a CGT event, otherwise known as a capital gains tax event? That's a great question to head through to support there, John. So you can head to selfwealth.com.au to talk about how your situation how you need to get things done inside your SelfWealth account. I'd love to answer the investing side of this question, which is basically how do you transfer it across? And you can just head to the selfwealth.com.au, get in touch with support, and you can transfer shares typically across. Although you may need to speak to your tax agent, because if you change, for example, the beneficiary, or if you change whose name the shares are held in, you may be up for some tax. But if you're just keeping it in your own name, typically there's not as much tax associated with that. So go and check out any of the information that's available on selfwealth.com.au. And it says, yes, Owen, it's in a low-cost investment bond with a tax saving in the long term. Yes, so that's a fantastic thing. So let's start this session. Let's get into the meat of it. So last week we talked about a few weeks ago, we talked about investing for income. Today I want to talk about investing for long-term wealth creation, aka growth. And the reason why is because one of the questions that you should be asking yourself before you even think about investing for your children is, what am I trying to do? What is my goal for these kids or for children? What am I trying to do? Now, one of the things that many of you will know, because we've talked about them in recent weeks, is that when you get an ETF, like say STW, which tracks the ASX 200. So this is just an ETF that invests in the 200 largest shares in the ASX 200 index. So if we look at the performance of this over the long term, we can see over 10 years or so, we can see that over the long term, the stock market tends to go up, right? From left to right. It doesn't go up in a straight line. There are some really risky times like we saw in 2020 when COVID hit. We can see the volume down the bottom here. There was some increased trading around that time. If we were to go back even further, we would have seen the GFC. Now, the reason that I bring this up is people often look at this and they look at, say, what is the stock market doing? And then they say, okay, well, why don't I just put some of my money in the stock market for my children? And it sounds great. and it is great, I think. But there are some things you need to consider. This is the US stock market over the long term. So, if you invested for your children back in 2012, look at the returns that you've got from that. And obviously, this has beat a bank account. So if you go into a standard bank account, you might get 1% per annum. So people think, okay, I'm going to invest for my children and I want that long-term growth. I'm not so much interested in the income from it right now. I want the long-term growth. So that's what we're going to focus on in this session, is basically this long-term growth. But if you want income, go back to the passive income SelfWealth live session that we did a couple of weeks ago, because that explains basically what to look for if you want income. So there is a fantastic article which I read today, actually this morning, just on getting started with a child's account in SelfWealth. And SelfWealth have made it really easy to set up a brokerage account, kind of like a brokerage. Think about it like a brokerage account within a brokerage account, or a separate portfolio within your main account. And so this tutorial here, and I'll just put this in the show notes. So here we go. Oh yeah, so Rob's just done it for me. Fantastic, thank you, Rob. So this takes 2 minutes to read, but it just shows you every step of the way what you need to do to set up a child's account. And obviously it's a major thing, and that's why SelfWealth has added this. But you can just in short, you can head up the top here and you can click on your profile and begin the journey to creating a portfolio for your child. The key thing to note here is, and I'm going to tie this back into long-term investing in a second, is you will need your tax file number to do this, and where you put your tax file number matters. Not necessarily in the application is very straightforward, but in general, according to the ATO's rules, where, depending on who has the tax file number put down for the investment, may actually, impact that person's tax return. So let's say, for example, that I want to invest for my children. I would put down my tax file number because I'm the one who owns the shares under the law. And then when they get old enough, I can transfer the beneficial ownership across to them. So the way that this would work is that I would pay tax in my name for the investments, and then eventually that would pass down. I could transfer those shares to my children. But this is where it's really, really important to get tax advice, because as Amit said in the comments here, he said, yes, Owen, the Australian Unity is a low-cost investment bond with a tax saving in the long term. So investment bonds are another option that are available to you, but investment bonds can have their own risks and benefits. So Amit says, it's for 10 years into the future, and that's correct. An investment bond has tax savings after 10 years. In the meantime, it can get a little bit, more complicated from a tax perspective. The other option that you have is when you invest, you can invest or you can save money for your grandchildren, or children, just straight up in a bank account. So let's say we have $1,000 to start for our children today, and every birthday that they have, we chuck in $500. So that would be once a year for the children. And the compounding frequency here is annually, and the number of years. Let's say that we have a child who is, let's say they're 8 years old. So we want to go 10 years, and we have a savings account that makes 1% per year. This is before tax, keep that in mind. So not very appetizing, but after 10 years of saving $500 on their birthday, starting with $1,000 today, what is it worth? And as you can see here, that our investment isn't really that tempting. After such a long period of time, we haven't actually made that much money. Oh, sorry, the deposit disappeared. Here we go. There we go, that's better. So here we can go, after 10 years, we'll have $6,336. And this is just the Money Smart compound interest calculator, guys, the free government-run Money Smart interest calculator. So here we can see $6,300 after 10 years. But let's say hypothetically we take this same situation. So the child is still 8 years old and we want to give them the money when they turn 18. The way we could do it is we could invest in the share market and say we give them a diversified portfolio that returns 5% per year. Again, I'm not including tax. I'm not including the fees associated with it, any of that sort of stuff. We're just talking generally here. So we achieve 5% per year, and it goes to $7,900. So obviously we've started to make more money. If we go again to say 7% returns per year, and I'm just throwing these numbers out here, we can see that the amount becomes $8,800. So all of a sudden, there's a substantial benefit from starting to invest for our children and starting to do it in a way that's more growth focused rather than a savings account. Now, for everyone out there who's saying to themselves, but Owen, isn't the share market riskier than a term deposit where you earn a fixed amount of interest? And I would say absolutely. However, over the long term, as we can see back in this SelfWealth platform here, over the very long term, the stock market does tend to rise. I'm not saying that's always going to happen, and I'm not saying that it's always going to rise at X% per year. I don't think anyone can say that. But what you can see here is that over the long term, the stock market does tend to perform pretty well. And there are some fantastic charts out there comparing, bonds versus property versus stocks. And the stock market does tend to perform very well over the long term. Okay, so we know that we want to invest for growth and we want to invest for a longer period of time. Now, if you're investing for children for the next 2 or 3 years, I would say that that's too short to use an investment in the share market. So one of the questions I often get asked by new investors is, hey, I'm looking to invest money for the next 2 or 3 years. What should I do? And I say, well, that's probably too short of a time frame. So maybe what we could do is, you could put more of that money in cash, keep it in cash, put it in a term deposit, put it in an offset account against your mortgage, and then keep your money growing that way rather than put it in the share market. Because if we zoom in, and this is the reality of investment, here we can see that over very short periods of time, the stock market becomes more volatile. But again, the further you zoom out, the more of an opportunity the stock market has to even out those big bumps that seem big at the time, but actually prove to be quite small with hindsight. So here we go. So here we can see, again, if we look at the Australian stock market, over the long term, we've still got bottom left to top right, but the more we zoom in, the riskier those bumps look. So here we can see it's not too bad just over the past year. We haven't had any market crash. But you get my idea. Basically, we're looking for the long term when we're investing for children. We want to do it in a tax-effective manner, and we want to do it in a way that's kind of simple. Now, just one final thing before we get to individual ETFs and to individual companies that might go on your watch list. One of the things to keep in mind is that every time there is a taxable event, you may be taxed. So, for example, if you sell an investment, you may pay capital gains tax. Like someone has to pay the tax. At the end of the day, someone has to pay the tax. So who pays it? Well, it depends on whose name it's in. It depends on how long you hold the investment, and it depends on what type of investment. So, a good example is, say, Fortescue Metals Group. When we looked in the past at Fortescue, we did this as a group. This is one of the SelfWealth lives going back a few weeks. We saw that Fortescue has paid some big dividends over the years. So if we come down to dividends down here, we put that on the chart for us, we can see that dividends from Fortescue have risen pretty quickly in recent years. Now, this is fantastic because what it effectively means is that, all the shareholders are benefiting from the income. But if you're investing for children for the long term and you want to keep that money invested, you still have to report that as income and you still have to put it on your tax return. So there's still going to be some slippage there from tax. So one of the things that I'm going to emphasize with you today is that to consider making investments where they are longer term focused rather than, say, focusing on that yield today. So yes, of course, it would be great to own Fortescue shares because we get franking credits, as you know. We talked about franking credits in a previous episode. But for the long term, we want things that aren't turning over as often. We don't have to turn over as many rocks because every time we turn over the rocks, that means every time we buy or sell or receive a dividend, there's a tax consequence. So we want to focus on the long term with our investing. So David Mars says a discretionary trust. And David, I assume that you mean you're using a discretionary trust to invest for your children. If you could confirm, that would be wonderful because I'm sure all of the other viewers would be, and myself, would be interested in this. But so just for those who don't know what a discretionary trust is, a trust is a separate type of vehicle which allows you to invest in multiple things and then effectively divert the income or the assets that are inside the trust. The thing about a trust, in my experience, and I'm not a tax agent, so you have to speak to someone about that. And David has confirmed, yes, he's using a discretionary trust for children. Discretionary trusts also come with a bit of a different tax consequence, but also a different accounting consequence. So you may have to rely on an accountant to help you manage that. trust. Yeah, so David said he's using it for protection and for tax optimization. Absolutely, David. So myself, I personally have a trust as well, but I don't use my trust for investing for children. I use it for investing in businesses. And so that's how I get that tax and optimization and that protection as well. So a good accountant can help you with a discretionary trust. But the thing to remember is this: in my research, what I've found is that in order to justify a trust, you have to have a fair amount of money already to go, and you're taking it very seriously. But if you're just getting started, something like a SelfWealth minor account actually makes a lot of sense, at least in my opinion, because you can effectively still invest in the stock market in a really simple way. Until we had things like this, you could only invest in different types of, ways that would be direct in your own name. So with this, at least we can hold the shares for our children until they come of age and then give them the shares or transfer the shares to them. Okay, so now let's get into the good stuff. How do we invest for children? If you have, so David says, $100 cost to have a trust tax return done. Yeah, fantastic. So David's just said that it only cost him $100 to do the tax return for his trust. And a good accountant, can charge you bugger all, to be honest. And so if you're that way inclined, absolutely look at it. I would say for most people that are just getting started and are looking for a really simple solution, something like kind of a miner's portfolio tends to make sense. Okay, so, and David, you might even be able to help me out with this, and I'm hoping everyone else can too. Given the premise of what I just talked about, the premise was we're looking to invest for children for the long term. How can we do that? What kind of investments should we be looking at? I'm going to take some suggestions here, so feel free to throw them at me. They can be ETFs, pardon me, they can be shares, they can be whatever you want. Put them in the chat and tell me what you think, and I'll start creating this. Portfolio for children. Okay, we can get rid of this. So what we're going to do is we're going to have some ETFs. We're going to put some ETFs in here. We might even put a lick in here, and we'll put 2 shares in. All right, 2 sets of shares. I'm going to lean on you guys a bit here, so we can get rid of all this stuff. We don't need to talk about dividends for this session. So we'll get rid of that. We'll go like this. Okay. Oh, Zoen's already chucked out one really good one, which I really like, and I was hoping someone would mention this. So bonus points to you, Zoen, for picking this one up. And while everyone else is contributing something, I'll chuck this in. So let's call it DZZF. This is the BetaShares portfolio, which we talked about last week. So this is the BetaShares Ethical Diversified High Growth ETF, DZZF for short. So if I say DZZF, this is the one that I'm talking about. So many of you will know from last week's session, this is an ETF that invests in other ETFs. So it's an ETF that kind of is a basket of a basket. And I think we added it to my stock watch list down the left-hand side here. Let's just go in and see if we've got it. Yep, we've added it here. So what we might do is in our SelfWealth account, we might add a little note here, and we might say, adding this ETF for my child's portfolio watch list. So there we go. We'll just chuck that in there. So I would indeed consider adding something like DZZF. DZZF. And so that's one investment that we could look at. Oh, Amit says small crypto account as well will do. Amit, love to hear from you in the chat. Why would you invest a small amount of crypto in there? Tell me, you've actually hit a really interesting point recently, because we've obviously had some ETFs start trading, which offer crypto exposure. So I'd love to know why you think it should go in there, and tell me which one would be interesting to you. So we've had a lot of people talk about Tesla. Okay, so I'm guessing everyone here is a big fan of Tesla because of the kind of renewable kind of focus on sustainable energy, building kind of greener transport networks and that type of thing. So if we can see in here, I think Tesla kind of hits the mark too, because for a small position in a portfolio, for the long term, Tesla has done very well in recent times. But it's important to note that Tesla is quite volatile. It does bounce around a lot, so we'll get to that in just a moment. But we can see over the last, say, 5 to 6 years here, that Tesla has started to hit its stride. We can see revenues growing, we can see gross profit growing. The one thing to keep in mind that it doesn't pay a dividend, so that's probably actually a good thing for us. It doesn't always make a profit. It's only hit its profitability recently, but that's still pretty good. Okay, so we've got some comments here from David who said the Crypt ETF. So CRYP, that's this one. So we can look at the CRYP. But I would love to know, David or Amit, why you think an ETF like Crypt is an interesting ETF. So not just necessarily like what is it and what does it do, but why do you think crypto should form part of a long-term investment portfolio? So why do you think that should be the case? Okay, so we've got Crypt. So Crypt is, if we drop in here, Crypt, there we go. So this is the Crypto Innovators ETF. It only launched last week and it's actually been very popular already amongst people who are looking for this exposure. 2.2 million units traded already today, which is a huge amount for a new ETF on the market. So DH says crypto is the future. Yeah, I think this is a really interesting thing, right? A lot of people say that crypto assets, here we go, David says it's the new world of banking. Yeah, fascinating stuff. So if we look inside the Crypt ETF, so if we go Crypt ETF beta shares, it's actually a really interesting ETF, I agree. So if we look inside the Crypt ETF, we can go to holdings here. We don't want to, no thank you beta shares, we don't want the notifications just yet. We just want to see what's inside the portfolio. So if I can keep scrolling, my mouse will play with me today. So we can see inside the ETF itself, we've got Galaxy Digital, we've got Silvergate, we've got Marathon, Coinbase. Someone wanted me to talk about Coinbase last week. So Coinbase, here it is. You can see we can just transfer easily between ASX and US trading within SelfWealth. And here we can see the financials of the company. We've obviously only got a limited amount of financials because the company only listed recently. And such as the nature of many of these companies are quite new and quite innovative. I think MicroStrategy, if we go back here, MicroStrategy might be one of the more recent or more longer term kind of sticky companies in this space, but fantastic. Okay, so Zamasu, oh, welcome back, Zamasu. So said sovereign nations will never give up control of their currency. Wow, yeah, this is a really interesting point that we find ourselves here in the discussion because people do tend to be very polarizing about crypto. I'm kind of on the fence. I'm not necessarily, out there investing all of my money in this, but I acknowledge it as a smaller portion of the portfolio. So if we just gave some very rough indications here, let's say percent of portfolio. Let's just use some really rough figures. So if this was my portfolio, I'm not saying for everyone, but if it was for me, acknowledging that for the long term, how can I invest in my children? How would I want to do that? Again, this is just for me. It's not necessarily how I would do it for everyone or how I would advise everyone to do it, but this is just for me. I would look to have quite a meaningful slice of my portfolio in something like DZZF. And 20% for me is a very big position. So keep that in mind. It's a very big position and it can be quite volatile. So David's given me some more interesting names to bring up here. He's brought up PayPal and he's brought up Square. We'll get to them in just a minute. And the other one is Tesla, which we know we've talked about already. Does anyone have any LICs or listed investment companies they would like to put in here and us to have a quick conversation about? So we've got LICs. I personally would like to go with something pretty diversified, pretty low cost for the long term. VGS is someone, yes, good one. So VGS is here. So this is the Vanguard International Shares ETF, VGF. Let's just go and have a look at some of the holdings inside that. So then we can see, what are we actually getting when we invest in this ETF? Here we go. So David, you did point out, they're all in the Crypt ETF. NIO, says GJ. I've never seen NIO. What is NIO? Let's have a quick look. NIO Inc. This is a really interesting business. I've never seen this before. I'd love, NIO, can you, so GJ, can you tell me what this business is and what it does? We can go back to the overview page here in SelfWealth, and we can see NIO designs, manufactures, and sells smart and connected electric vehicles. It manufactures autonomous driving electric vehicles integrated with next generation technologies and artificial intelligence. Well, fantastic stuff. I've never come across NIO. I wonder why I've never come across it. Interesting. Oh, it's a Chinese EV maker. Ah, I see. Okay, that makes sense. Possibly the closest competitor to Tesla. Interesting. Hey, quick question. I would love to have an electric car, but I don't have one already. How much would it cost me to get a car from a car from NIO? I would love to know, because I don't think I can quite afford a Tesla right now, at least not in the middle of a renovation. Okay, so if we're back inside. We're back inside the VGS ETF, and we're just looking for what's actually inside it. So I'm just going to zoom out a bit. This is too close. And so we can see here some of the biggest holdings include Apple, which I own, Microsoft, Amazon, Facebook, which I also own, Alphabet, which I also own, Tesla, which we saw, Nvidia, JP Morgan Chase, Johnson & Johnson, Visa, and the list goes on. Even Berkshire Hathaway from Warren Buffett is in here. So many great companies. So this is another fantastic ETF that focuses, is ideal for long-term investing because international ETFs typically don't pay as much in dividend income, which suits our process of looking for long-term investments that don't necessarily incur much of a tax burden in the short term. So we can see started in 2014, it's got $4 billion invested in it already. If we come down, we see it's got 1,500 holdings inside of it. We can see the dividend is only 1.65%, so that's good. And everything's looking pretty good. So I would be happy to have, personally, I'd be happy to have a small allocation to VGS. So we'll just chuck that in here. And these, again, just examples for this session. Obviously, I'll try and disclose anything that I do own along the way, but, you know, all just examples. So we might have, say, 5% in something like that. David has called out another ETF, which I'm familiar with, which is VDHG. VDHG. Put that in the wrong spot, like this. So we've got VDHG, and as we will know, that many of them, many of you will know that I own VDHG. So this is one that I own already. VDHG is very similar to DZZF, except if we go back to SelfWealth, here we go, VDHG, and we can see here, it's also a diversified ETF, but it does something a little bit different to DZZF. It doesn't have the ethical filter. So we can see here the stock market's performance. You can see that it fell in 2020 around the time of the coronavirus outbreak. So it does something very similar. Let's just have a look at the name of this. Vanguard Diversified High Growth Index ETF. If we go back, BDShares Ethical Diversified High Growth ETF. So that's the key difference. One of them has an ethical overlay, one of them doesn't. So keep that in mind. If you are, inclined to think more about the ethical side of investing and how that impacts you, you can head over to the BetaShares website or any of the ETF providers' websites that provide ethical ETFs. GJ, how about the SPY ETF, the S&P 500? Let's have a quick look at it. So SPY, the Spider S&P 500 ETF Trust. So we can see here it's got very comparable performance over the long term to the other ETF, which is in the space, which is IVV. This, from GJ, from where I sit, I prefer this ETF. I find it very simple, Australian domiciled. It has a very, very, very low fee structure. I mean, they're all pretty low when you're investing in the S&P 500 these days, but IVV is kind of my preferred exposure for the S&P 500. So another great ETF. Here we go. We've got a description. The S&P 500 ETF from iShares is an exchange-traded fund. The fund seeks investment results that correspond generally to the price and yield performance of the Standard & Poor's 500 index. So it invests in large capitalization sector of the United States equity market. And so this is another ETF that will own things like Microsoft, Amazon, Bank of America, Berkshire Hathaway, etc., etc. Okay, so here we go. We'll chuck this one in too. So I'll get back to VDHG in just a second. But so far we've got IVV. So this is from iShares. So why don't we say, maybe say 10% in something like that. We could say 20% in VDHG. Again, this is a higher risk portfolio. We might chuck, say 5% or something like this. This is just me just putting the numbers out there, guys. As Rob said before in the chat, don't forget that anything that I mention in this session is limited to general financial advice. This is just us having a bit of fun creating a portfolio from scratch as if we were investing for kids. And don't forget too, as all of you know, I run my own business. I'm an analyst by day. I host some podcasts for Rask Australia. That's my day job. And so even though I do these sessions with you, I'm not necessarily paid to endorse anything. So I just think that SelfWealth's a great like-minded business. And one of the things that they're doing now for the rest of the year is offering $0 brokerage on when you invest in an ETF. So $0 buys. So when you invest, it costs you nothing to invest in that per the brokerage. Of course, you still pay the management fees to the ETFs, but you don't pay the upfront brokerage. If you sell, you do, but not for the buys. Demona Da Vinci says, don't forget to smash the like button, guys. Helps others find the channel's content. Oh, that's great. Thanks, mate. That's really nice of you to say that. So yeah, that's one thing I forgot to mention at the top of the show. If you want to just hit subscribe or like on the video, and then you can find out, you can keep up to date with when we go live, for example, next week. So we've got a few ETFs in here so far. Demona Da Vinci said crypt is a bit of hype. Yeah, so there's a lot of hype going on right now in many of these crypto companies and crypto assets. So David brought up Square, for example. Square is, I'm not sure if many of you know Square personally or intimately, but let's have a look at Square Australia. Never mind my typing. So here we go. So Square started as a business by Jack Dorsey, who created Twitter. And basically the business is involved in creating the terminals that you see, or the point of sale terminals that you see at restaurants or at cafes. You see this little square thing here. That's basically what they create. And they charge a fee to do that. So it might be 1% of the transaction goes to Square. And they also charge the retailer for this terminal as well. So that's how they make money. But more recently, what they've done is they've expanded by creating their own app, which is called the Cash app. And the Cash app is available in the United States, and it basically allows for instant money transfers. They also have things like cards in the US. They have things now more recently like brokerage. And the big one is, and this is how it relates to crypto, is they also allow their users to buy and sell cryptocurrencies. So this is all within Square's Cash app. The other company, and it's a bit ironic that this happened actually. I was just here on the Square site, and some of you may have seen that something popped up in my right-hand corner here, and that was actually Honey. And Honey is a browser extension that you can use. You can just add your extensions to your Chrome browser up here, and it actually allows you to find coupon codes and deals on a website. So it comes from PayPal. It's owned by PayPal, which is a competitor to Square, but it popped up on Square's website. And so PayPal is another company, as David suggests, is included in cryptocurrency, because PayPal now too, also in the United States, allows you to buy and sell cryptocurrencies as well. So both of these massive fintech companies are allowing you to buy crypto, to purchase things in crypto assets. And that's basically what these two companies are trying to do. They're trying to create what's called a super app. So you see one right here. It's where you can have like your PayPal balance, you can have rewards if you use Honey or something like that. You can have your crypto assets, and soon, you can already do this in the US, but soon, maybe here in Australia, you can have your paycheck go into the app, and so you can do all of your banking from one place. Anyway, so let's go back to this. I own PayPal shares, full disclosure. I do not own Square shares. So let's say we put 2% in this, 2% in this, and I'm just starting with really small amounts, obviously, because these are higher risk investments. Even 2% is quite a big position of a portfolio. So just grab that, drag that down. And I might just check to make sure that these are in my watch list inside SelfWealth. So here we go. I think we've got Square in here. Yes. And have we got PayPal? Yes. Have we got Tesla? No, we do not yet. So we'll add this in. So we'll go TS Tesla, and we'll go adding to the watch list for my child's, we'll do capital, portfolio watch list. We could just create a separate watch list up the top here by going like this and saying children's portfolio. Obviously, I don't have a child's account set up in this demo account today, but if you did, you could have two portfolios and you would have a separate watch list and a separate portfolio for that child anyhow. So we can see here we've got child's portfolios, it's popped up down the bottom. So let's add some of these names. We've got Tesla, we've got VGS. I'll just put a few of them in, I won't necessarily bore you with everything. We've got DZZF, already exists in my watch list, okay. Oh, and the wrong watch list, that's why. DZZF, and so on and so forth. And then we can create a separate watch list for our children down the bottom here. Okay, so Zamusu said before that MVW is a solid ETF for investing for children. So MVW, let's take a look at this ETF. This is actually an ETF that we haven't talked about recently. So this is a really, really interesting ETF. And what does it do? Well, the ETF invests in Australian shares, but it does it in a different way. So this, you can see the performance of the MVW ETF over time here. This is the Van Eck Equal Weight ETF. Equal weight ETF. Keep that in mind. Equal weight is what I said. So here we go. The one that it gets compared to is VAS, which this is the biggest ETF in Australia. It basically goes the Vanguard Australian Shares ETF, or VAS for short. Then it goes Daylight, and then all the other ETFs. This is the ETF that's right at the top there. But we were talking about MVW, and this is a really interesting ETF. I'm sorry if I get a little bit technical here, guys. But what MVW does is it invests in shares on the Australian share market, but it doesn't necessarily just buy the biggest one. So let's go to that. Let's go find that, Van Eck MVW. So here we go. So here we can see what it says. It says MVW gives investors exposure to a diversified portfolio of ASX listed securities. And then if we come down here, it says MVIS, which is the index that it follows, is a pure play rules-based index that combines benchmark with blue chip characteristics by tracking the performance of the largest and most liquid ASX shares. So if we come down into the portfolio analytics here, this is just on the Van Eck website, we'll just say we're an individual investor. Thank you, I agree. So here we can see that the ETF has 96 holdings. There's $1.7 billion invested in it already. And we can also see, importantly, that it's been around since 2014. That's good because it shows us it's been around a long time. We can see that it's 100% invested in Australia. It's got a diversified mix. So there's one of the things that many of you will know is that in Australia, the big banks, aka Commonwealth Bank of Australia, Westpac Banking Group, ANZ, and so on and so forth, make up a huge proportion of the index. So here, why don't we actually bring this up so I can show you what it actually looks like. Vanguard VAS ETF. So normally when you invest in, say, the ASX 200 or the ASX 300, very, very good question here from RTN725. Would we be doubling up by investing in VDHG, VGS, and DZZF? Great question. I'll get to that in just a moment. So if we come down and we look at the portfolio of the VAS ETF, once again, this is the big ETF here in Australia, we can see that 30% of the ETF is invested in financials. So that's like the banks, it's the big insurance companies, the companies like Suncorp, which are hybrids. So you can see here, Commonwealth Bank, Westpac, NAB, ANZ, we can see Macquarie Group. These are all banks, right? Now, remember this number where it says up the top here, 30%. Some investors and some financial advisors and professional investors have recognized that financials shouldn't be this much of a diversified portfolio. So what Van Eck did is Van Eck said, well, what we'll do is we'll lessen the exposure to the banks, and we'll put more of that across the other sectors in our stock market. And so what we can see here, there's only 18% exposed to financials as opposed to 30% from the VAS ETF. So this is an interesting ETF. It comes with its own unique set of risks and I guess volatility being one of them. That's the thing here. It has its own set of risks. But if we go back, we'll add that to our children's watch list because I think this is one way to get exposure to the Australian stock market as opposed to the US stock market. So we'll add this in. MVW. There we go. Now I'll just go back into this little spreadsheet I put together here. We'll put another ETF in. So MVW, and we'll say this can be, I don't know, or we say 15%. So what have we got so far? We have 81%. We're not quite there yet. So this would be the sum of all of these things. There we go. So we're at 81%. And Artian makes a fantastic point here. Would we be doubling up by investing in this and in this? So both of these have Australian shares, international shares, and bonds inside them. So that's what this has inside it, and that's what this has inside it. So if we have this one and this one as our two biggest positions, what we are getting is we are getting shares inside, Australian shares inside this ETF, we're getting international shares and so on and so forth. But we're also getting that inside this ETF. So is that too much? And I think, Arjun, there's, what we're trying to do today is kind of just illustrate kind of the basics of how do you build a portfolio and how do you, allocate money for a child. I don't think there's anything necessarily wrong with being very simple. And what I mean by that is, investing is one of those things where you don't get many points for being original. Sometimes you think that you're being very smart by being more technical, when in reality, to be honest, it's often easier just to keep it simple and just go with the boring thing. And so what I mean by that is, let's say, for example, if you just took this out and you just put 30% in here, or we could even put more in that, say 30 or 40%, you still would have the same exposure, to your point, right? You still have Aussie shares, international shares, you'd have some bonds, very small amount of bonds, but you'd still have some in there. And you don't even need that position that was there. So that is perfectly reasonable. I think when I invest for my children, I don't have kids yet, but when I do have kids, I think I'll be investing in very simple ways. So I won't be having multiple positions like this. I might have, say, 5 or 10 ETFs. And then what I'll do is I'll just slowly add money into that portfolio for them. And so I think, what we're doing today is just kind of like showing some examples of how you can do it. Another good example here in the international share space is something called MFF. I went on the television not too long ago and I spoke to David Koshi from Sunrise, and he was asking about how to invest for children. And one of the other guests that was on the show with me suggested this company called MFF Capital. And MFF actually appears in our portfolio example for the passive income session that we did. Sorry about that, I stumbled a bit. We talked about MFF here, and it's basically like Magellan. So many of you will know what Magellan is. Magellan is this company, except it's a company run by his co-founder of Magellan, who now invests money in a very low-cost way. So this is the Magellan that many people know, but there's this one that kind of sits off to the side, which is also very, very respectable. And it pays a dividend and it does all those types of things that we want it to do, but it's not a huge dividend, so we're not going to incur huge amounts of tax. It's actually a really effective way to invest for the long term. So I'm actually going to put this one in there too. Let's just say 5%. Now, there was actually a fantastic article written on SelfWealth, and this is where I'm going to change gears a little bit. So SelfWealth, investing for kids. And there's an article here written by Renee. And Renee basically says 5 reasons to begin investing for kids. And goes on to write, to teach kids about the vital money lessons, to help them find or follow what they're passionate about, to make every moment count by starting early, to work towards the child's future needs, to top up, contribute, and invest anytime you want. And so this is a great list of reasons why you want to begin investing. I have one more question. We're into the last 10 minutes, and I'm sorry if we've kind of gone around about a bit like this, but I want to ask a question to you all. is how do you teach your children about money? How do you teach your friends and family about money? How do you teach them about investing? Because I think one way to do it is to invest for them. But another way you can use your investing is, for example, by showing them companies down the street. So one of the companies that I might invest in for my children is this company. I don't know why that's a different color. Just bring this down. Now, does anyone want to tell me what this company is? I'll hold on a second, and you can tell me this is the stock ticker symbol, and I'll give you a hint. It's a US share. You can tell me what it is. Anyone? I don't have any. I don't know. This is a show about investing for kids. I don't have any chocolate or anything to give away. Disney, says Demodern Da Vinci. Yes, got it in one. So Disney, and I would invest in Disney for my children. Why? Not necessarily for the investment returns. Thank you, DH. You followed in quickly behind Demodern Da Vinci. Why would I invest in Disney for my children? And yes, Disney has been a wonderful company to own over the long term. Yes, it's had its ups and downs. But Disney is a fantastic way to teach your children about money. And not necessarily because, you pay a bucket load every time you take them to Disneyland, or if you go and buy some Marvel's Avengers gear or anything like that. But Disney is a truly wonderful business, and it has inspired children for over 100 years. So if we go Disney, Walt Disney Companies, and so we can actually go here, and there's been some fantastic images that have been created on the internet. This one here comes from Tidal Max, and I'll try and zoom in on this if I can. I don't know how well it's going to work for me. Not really. But if we just stick with this one, then Betty Sue says, because every kid likes Disneyland. Yeah, that's right. So that's why I invest in it. Hey, I'm an adult, so maybe every kid includes adult kids. I would take that. So here we go. We've got all of the businesses that Disney owns. Well, this is just some of them. They've actually got many, many more. You can't really see it from the small image, but that image is available online. And here we can see basically all of the different brands. So we've got 20th Century Fox. We've got a bunch of different brands. So it's a really, really a diverse business, and it's a really long-performing business. Good performing business, I should say. So I would add Disney to my list, and I would say add 5% of them. Does anyone want to give me some more examples? We've got a couple of minutes left here, so I want to try and pick your brains. Star Wars, says Hartley. Star Wars. Which kid doesn't love Star Wars? Or Snow White, or Marvel if they're a little bit older. Which kid doesn't love that? John Clark says every kid wants the Disney Channel too. Yeah, I don't know about you guys, but I'm the big kid in the family, and we have Disney Plus streaming at home, and I tell you what, it is good. So we've got a couple minutes left. I want to pick the brains of everyone here, and I want to ask you, what other companies are like Disney could you use to inspire your children to invest and teach them about money? Imagine you're at the checkout and at a supermarket, or imagine you're in a shopping center and you're walking with them, and what are the companies that you could get them to go, oh wow, like that's really interesting. Tell me what they would do. Which companies they would be, or which companies would inspire them, and which ones would really get them thinking. I'd love to know what you think. Amit says, so great. Yeah, the Barefoot Investor book is a fantastic book for children. Betty Sue asks the questions, how frequently will you add money in an ETF? Will you add equally to each ETF, or will you add money in only one ETF, say every month? Great question. Okay, so we've had some good examples come through here, and I'll just get to them in a moment, just to end off. But Betty Sue, that's a fantastic question. So here we've just got an example portfolio, right? So if we actually look at this, if we just put all of this together right now, we would say that this is a pretty high risk, high growth investment. This is a pretty high risk, high growth investment. This is all stocks, but it is, it's still very well diversified. We saw it had 1,500 positions. This one has a lot fewer positions. It's focused on cryptocurrencies. PayPal's, the reason that I made PayPal a smaller position, and Tesla a smaller position, and Square a smaller position, and Disney a smaller position, is because these are more risky than these up the top here, because these are diversified. Even this one has nearly 100 positions. This one has 500, sorry. This one has nearly 100 positions. And so when it comes to adding money, it's important that your portfolio remains in balance. At the moment, if we looked at this portfolio on paper, this would be 90, let's say, I don't know, I'm just off the top of my head, 90% of this would be in stocks, which is too high for most people. And then say it's only got, it's got 0 to 10% in less risky stuff. So I'm just going to write less risky in air quotes because everything has some risk, but this is just less risky. And so, to be honest, what we've done today is we've just thrown out ideas, and I've just given you very, very rough examples. Even though we have a child's portfolio, I want to just remind you all that the portfolio is still managed by you. If you're the one setting up this portfolio for your children, it's still managed by you. And oftentimes in investing, the single greatest enemy that you have to long-term returns is yourself. And so you should treat the child's portfolio as if it's your own. And by that I mean, if you're going to invest 100% of it in shares and share market ETFs, so like ETFs that only invest in shares, like this one here, you've got to be prepared to ride out the bumps because there will be scary times. So I would say consider adding things like bonds to the portfolio, a small amount. Consider adding some property securities. We talked about all of these the last week around. So we talked about these here. Like you could add, say, in here, you could add REITs. You could add any number of things in here to kind of make it a more diversified portfolio because at the moment, this is quite high risk, just to being fully... This portfolio, as Masu says, will be very tech heavy. Yes, another fantastic point. So this is going to have a lot of these are all technology companies, or Disney's more of an intellectual property company. This is a financial company. This company invests in a diversified portfolio. This will have quite a few technology companies. This will have technology companies. This will have almost a lot of technology companies. So yeah. So that's right. So Musu says maybe something like a Walmart or a Coca-Cola might help bring in some lower value. So let's just take some of these examples right at the end. Harley asks, what is a bond? So that's actually a great question. I actually did a podcast on this recently for the Australian Finance podcast where we talked about bonds. Go and check that out. So it's the Australian Finance podcast. Hartley, I don't know if you said that tongue in cheek. I think you might have because I think you've got a bit of a sense of humour. If you don't, you can go and check out the Australian Finance podcast, and I explain a bit more about bonds there. So we've had some great suggestions come in here. We've obviously got Coca-Cola, so that's KO from Zamusu. KO here, if we jump into the platform, right here, so Coca-Cola. Obviously, at the checkout, your children are going to see Coca-Cola logos everywhere, so we can have this business in there as a way to teach them. You can say, hey, when we buy this can of Coke or this bottle of Coke, some of that money goes back to the company that you can invest in. You can put your money and invest in the company that makes that. Another one that was brought up was here with Roblox, which is a fantastic kind of more modern Roblox. Here it is. So Roblox is obviously a gaming company. It's kind of playing on this kind of new era of technology where you're more immersive and young people love this. I reckon if you had $1 for every minute that a child spent playing Roblox, well, the world would there'd be a lot more problems solved than world hunger for those of you that are keeping up with the news with Elon Musk, because Roblox is incredibly popular. Another company that you could look at if your child's into gaming is a company called Activision. Activision Blizzard is out of the US. It creates games like Call of Duty, World of Warcraft, and so on and so forth. Another one is Take-Two Interactive. Take-Two, that's not here. I think it's TT. I can't remember the exact ticker code if someone knows it. Another one that you might look at is EA Sports, so Electronic Arts. Have we got it here? There it is, EA Sports. For those of you who like soccer, this is the company that creates FIFA, which is very popular for children too. So if your child is more of a gaming or into soccer, you can say, you can invest in the company that creates this game, and then you can throw that in there. So there's been some fantastic conversations today. Vishal said Nike. Nike, obviously, many children are going to be walking around in Nike. I definitely wasn't when I was growing up. I think I was walking around in gumboots and Maybe it's kind of some sort of knitted jumper in the mud, but many kids these days are walking around wearing Nike and the new shoes and so on and so forth. Nike has a fantastic growth story, kind of out of China, and then also diversified throughout Asia. So another really interesting business. So let's just summarize what we've got. I just want to kind of throw some ideas out there. Sorry, one more final thing here is David did mention the ESPO ETF. The ESPO from Van Eck, this one right here. This ETF actually invests in video game companies and esports companies. So you can kind of get all of them in one basket if you like. So another interesting one. So this is summarize what we've got here. We've covered basically how do you create an account, how do you invest for children, remembering that the tax consequences are basically in your court. So we've got you paying tax, so we want to minimize the ongoing tax, and we also want to set up the account properly. So speak to your tax agent so you understand the tax consequences now. And the reason that this is really important is, let's say you invest $500 or $1,000 for your child today, and you think, I'll just chuck it in there, no worries. Well, in 18 years or 21 years or however long you want to give that to them, that money could be substantial. And so if you think to yourself, oh, damn, I wish I sorted it out properly the first time, now is the time to do it. Get some tax advice, pay a little bit extra, do some reading on the SelfWealth website, read the ATO website, we included the notes there, and actually set it up properly. Take your time to understand how it works, because tax is the biggest cost of long-term investors face. It's not brokerage, it's not all of this, it's capital gains tax, selling and buying too much because you make mistakes. It's constantly paying dividends, getting dividends. Now, dividends are great because you can reinvest them, but you do have to pay tax when they're paid to you. So you want to manage that effectively. We've had someone in the chat say, I use an investment bond or insurance bond. Other people I know use offset accounts. So instead of creating separate accounts in brokerage platforms, they just put their money into a mortgage, and then that saves them interest. The final thing that I want to add, and this is more for parents rather than grandparents. Many parents come to me and they ask, okay, so I'm investing for my children, and I really want them to do well. I've got my mortgage, I've got some money saved up, I want to invest for my children. Okay, no worries. But many of the parents that come to me want to invest because they want their children to have the best education. They want them to be able to. They want to be able to support them to go on holidays. They want to be able to support them to buy a house and do all of these things many years down the track. Well, here's the newsflash. You don't have to set up a separate account to help them do that. One of the most important things parents can do with money is actually just take care of their own financial affairs. So get yourself in the right position. When you jump on a plane, I'm here in Sydney, I got on one yesterday, first time in many months. And one of the instructions in the safety manual is put your own life vest and fit your own goggles, your own air mask first before you fit that of an infant. Because there's no point setting up the infant's mask if you're already passed out. So put yours on first, get your financial affairs in order, and then go and sort them out. And so that's just a simple way to think about having good financial hygiene, investing for the long term. We've talked about ETFs. We didn't really talk much about listed investment companies or LICs. We didn't really talk much about bonds, so Hartley asked about that. We can do a session on bonds. If you want us to do another session on a particular topic, I love ideas. I come up with these ideas every week. I just want you to tell me, what do you want to know about? Chuck them in the chat. Do you want to know about a company? Chuck them in now, because I'll put it on the list for next week. The final thing is, one of the most powerful things you can do for children, whether they're your children or someone else's, or like your grandkids, is talk about money. Conversations about money shouldn't be taboo. The less we talk about it, the more intimidating it becomes. Have open and frank conversations around the dinner table. Speak to your children about money. Teach them to budget. Teach them to give back. Giving is actually a wonderful way to empower children to learn about money. Teach them to be charitable. All of these things. Teach them the value of earning. All of these things are really important strategies that you can, as a parent or grandparent or friend or family member, instill upon your child in a very simple way. I've had some really good guests on the podcast, and many of them have said one of the most powerful things for them was actually just talking with their parents about money. My partner's parents had a great anecdote or a great example is Whenever my wife was young and she used to have to get like car insurance or go in and pay for a bill, the parents would send her in to do it rather than her doing it, rather than them doing it for her, to try and teach her that this is how you pay a bill, this is how you would do this is how you do that. So try and get them involved in that. So Hartley says, I want to learn about bonds next week. We're going to do that. We're going to learn about bonds sometime in the next few weeks. We're going to talk about how you can build that side of the portfolio, the defensive side, alongside the income, alongside the growth. So some fantastic stuff here. So yeah, wonderful chat today, guys. I'm here up in Sydney. The weather has kind of turned on today a bit. It was a bit ordinary yesterday, so thank you so much for that. Anyone that has any influence over the weather, I thank you for that. I've escaped Melbourne with the team here. So some fantastic topics to come up in future weeks. Be sure to check back in. Be sure to hit subscribe. You can find me on Twitter at Owen Rask, and you can use the hashtag SelfWealthLive to get in contact with us. So thank you everyone for tuning in today. It's always my pleasure. I just love these chats. So thanks for the questions. David, thanks for your contributions today, especially, mate. I really appreciate you talking about discretionary trust and all the different things. If you want any more information on me, just head to rask.com.au. Thank you so much for tuning in.